fundamentally, how is the U.S. doing? Like when you think about it.
I think if you take a step back and you look at the incoming data, we have an economy where growth has been very resilient. The economy has experienced abnormal and historic shocks over the past 12 to 18 months. And despite that, the economy has been continuing to grow at 2% or above. The labor market, extreme volatility in the month-to-month readings. But if you look at the unemployment rate today, is about where it was last summer. It's still at historically low levels, almost 4.2%. Most measures of labor market slack are very stable. The hiring rate has been stable. The quits rate's been stable. And so despite all the worries, despite the fact that we are experiencing the significant adverse shocks that are putting attention to the Fed's dual mandate, the economy is actually performing quite well.
The economy is not monolithic, and there are different parts of the economy. And the way that different people feel this energy shock is a lot different. We spoke to Chris Britt, the CEO of Chime, last week, this neobank or fintech, whatever you want to call it, where the average income of the user is about $75,000. He said his consumers' fuel spending rose 25% over the last month as a result of the war with Iran. What does it do when that consumer is hit so hard to your outlook of the U.S. economy?
Yeah, you've had an economy, and part of this is always the state for the U.S. economy, which is that it is heavily skewed in terms of the impact of consumer spending towards higher income households that drive a disproportionate share of consumer spending. Now, the shocks that we are seeing tend to be regressive. So they're hitting the middle and lower part of the income distribution more. So they're raising fuel prices. They will be raising food prices most likely. The tariffs that we've seen impact goods more than they do services. So all those are negatively impacting the lower part of the income distribution. That part of the income distribution is generally always more fragile, but has been shown to be more fragile in an environment of higher interest rates, higher inflation that we've seen. But if you take a step back, all of the aggregate spending data still looks quite good. Consumer spending looks relatively solid. From a business CapEx perspective, yesterday we got durable goods orders and shipments, which remain pretty solid. So there's still these kind of distributional concerns about the consumer and the broader economy. But on average, in the aggregate, things look very resilient.
So we keep talking, Matt, a lot around this table about the longer impact of the war. And I can't remember if
protracted.
Protracted.
In the words of the Federal Reserve.
Yes, exactly. But I just think about, and I can't remember if we've talked about this yet with you, is that this idea that you have nations thinking about what they need to protect domestically for their national security. And so producing more at home, making sure they have access to raw materials. I don't know. I'm obsessed with this about the rethink. And I do wonder if that's factoring into your models longer term. And with that, I think about labor costs in here, that would make things probably more expensive here. Even if you take out the moving stuff around costs, I just think about what that does to inflation longer term.
Yeah, so I think there's probably two aspects of this. One is supply chain resiliency, and it was a key topic coming out of the pandemic. And maybe we've forgotten a little bit about it over the past several years, even though you had this historic tariff shock.
Yeah.
But what's happening over the past month certainly intensifies those concerns. Now, it might mean that you have to invest more across multiple supply chains. You incur more costs because of that, and therefore, yes, you're more resilient, but at the same time, your average cost is higher. And so that could feed into inflationary pressures. The other part of this is how are people thinking about their own defense? And so, can European economies rely less on the U.S. for defense? I think certainly we've seen Germany take a strong stance on that position. Significant investments in their own defense industries and infrastructure. And that will mean globally fiscal policy is more proactive than it has been in the past. And because of that, inflation will be higher. As
guns versus butter, like I'm thinking about the impact on what that does for society.
Correct. I think ultimately it will squeeze out and push out some of the private sector. Will overall raise interest rates, keep interest rates higher, and inflation higher.
When we talk about a duration of a conflict like this, I think there's this idea that we're in a period where a ceasefire has been announced, but it's clear that things aren't going back to what they were before February 28th. Oil's not there. Maybe the excitement about what it could go back to is there, but there's still skirmishes happening, and there's still negotiations to be had. Is there a chance that the war may not look like it did in the first 5 weeks, but there is still a heavy presence by the United States and Israel in the region for a long time to come, and that affects the economy?
Yeah, I think we have to think that there's still uncertainty here, right? We're in day one of what is still an uncertain truce at this point. And so, how the world looks 2, 3, 4, 5, 6 months down the road remains highly uncertain. I think it is very likely that energy prices are just higher than they were before the recent events. In part, that's because even if the Strait of Hormuz picks back, reopens fully, and we're clearly not there yet.
No, it's oil transit remains halted now.
Correct. So we're clearly not there yet. But you've had some damage to energy infrastructure in the region, which is absolutely critical, and that's going to take longer to get on track. So I think regardless, you are likely in a world where energy prices overall and therefore inflation for this year is going to be higher as a result. Now, I think the U.S. economy can absorb that, and I think that it can be resilient in response to that. I think if oil prices were to move up to $150 a barrel, that's the period where we became really worried that it could wipe out the benefits of tax cuts to U.S. consumers. You might get into nonlinear effects on the economy where growth begins to be more damaged. So, yes, I think it has lingering effects on inflation. I think that impacts the Fed in a hawkish direction, but it doesn't necessarily overturn a relatively resilient view for the economy.
Matt, I want to throw one more thing. And, before the war, every conversation either started or somehow worked its way to artificial intelligence. Yeah. And you guys have done a lot of work. Certainly, we've talked a lot about the potential impact on the labor market, but you guys also did a recent note on AI's maybe impact on inflation. What did you look at and what did you guys find out?
Yeah, so I think if you think back 6-7 weeks ago, the entire conversation in markets was about how AI was going to be disinflationary and was going to displace labor, both of which was going to put downward pressure on inflation and on interest rates. Now, obviously, that's completely gone away from the discussions at the moment. But I think there's just this very strong conviction in markets that AI is this massive disinflationary force. One thing that we did is we actually just went out and asked various AI tools whether or not they think it is going to be disinflationary.
Did the tools explode?
They did not explode.
Okay, that's a good sign.
And people, they joke, yeah, of course, if you ask Hal whether or not it's going to take your job, it's going to tell you no. But
I'm sorry, Matt, I cannot answer that for you.
Just got about 40 seconds.
Sure. So, but from the inflation perspective, I thought you found really interesting results. So AI is not at all convinced that over the near term it's going to be a disinflationary force, and it highlights, I think, key factors. There's a big investment boom that's taking place. It can add upward pressure on energy prices.
Yeah.
But even if you look over the next 5 years, it puts about an equal probability that AI is a significant disinflationary force to it lifting inflation. And again, it's kind of highlighting a lot of these supply chain issues and the investment demand part.